We'll get asked by a new client how we choose to buy a stock, but I think the more valuable question is, when do you sell a stock? So we don't have price targets. We don't have research analysts who tell us, sell this stock if it hits 300. We'll own a company for decades as long as it keeps growing. And we'll own a company during rough patches as long as fundamentally we think the business is still intact and is still solid and its moat is still there. Moat is a curious term and it's very subjective, but we're looking for margin of safety. Now, obviously this is perceived, it's not tangible, but you can look at certain businesses and just tell there's qualities about them that make them very difficult to break or decay, that they have a true wide moat around that business. We sell 1, 2, even 3 stocks a year, but those are generally going to be situations where that moat is now in question, where what made that company great is no longer still there. What gave them a uniqueness is no longer there. Now, we're very careful about what we buy in the first place, so it's unusual to have a company break down, but it does happen. And there are times we will watch it for several years thinking, no, their moat's still good, they're going to turn around. And we've owned stocks that experienced 30 or 40% declines and then ultimately turned into 10-baggers. And a 10-bagger means your money went up tenfold over the period of time you owned it. But there are other times where a stock's down 40% and it's not coming back. Or there's clearly a better use for the money. And that's the concept of opportunity cost. Even if that stock bounces back, you could have put the money in something else and gotten there quicker. There's a behavioral finance term about sunk cost, and it's a mistake a lot of investors make. They bought a stock at 100, it's now trading at 55. They don't want to sell it until they're even. That's a bad practice. You need to look at every business every day and think about, am I buying it now? And we think about our accounts that way, that when we get to the point that we no longer want to buy shares of a company for a new client, and not because it's a little expensive, but because we don't trust the company anymore, that's when we sell it. Now, we have stocks that have just become overvalued that we might not buy for a new client, but we still believe in the company. But at the point in time that we've lost confidence in a company enough that we won't buy it for a new client, that's typically when we sell it for everyone. Now, we do manage money on a discretionary basis here, and that works in your favor, but for some people, they don't like it. And this is why. We sell everybody out at the same time. Our largest client, our smallest client, same day, same price, same execution. That's great in that it's immediate, and if something is happening, it's quick. But I know some people like to talk about it. We might be a bad fit if that's something you want to do.